Quiet. All right, everyone. We are up and running today. I'm Jason Ursi of Ursi Holdings. I'm joined by my bulldog, Jack. So actually, if you see, Jill, sorry for that. And I had Jack in my mind from our other bulldog right there. But Jill's joining us today on the webinar here. I am Jason Ursi of Ursi Holdings. Share a little bit more about our company here. We are, of course, a multifamily investment firm. Now we live down in Nashville, Tennessee, is where us and our company are located. We focus on BC assets, multifamily assets, repositioning assets. We're in about 5 markets right now, over about 1,500 units, valued a little over 160 million, with another 50 million currently in the pipeline. So our focus is looking for underperforming assets, whether it's on the property side or the management side. Typically, we find they go hand in hand. If a property is underperforming on the building side, it's typically because the management is lacking some clear either focus or process, or they're not capitalized well. If we find that, of course, the management is having issues on the other side, that carries over to the business. So today we wanted to talk to you a little bit about us, right? So we're really excited to be here in front of you talking about Ursi Holdings. Also, we want to talk to you about our event coming up very shortly. It's called Multifamily Live. We will be in Nashville, Tennessee, June 2nd, 3rd, and 4th. I'll get to this real quick. Let me move this out of the way so I can get this up as well. So, of course, in person. Last year, we did it virtually. We had a huge turnout. Thank you for all that attended the meetup here. It's basically 3 days of everything multifamily. We dive into how to find leads, how to look and identify the right market for you, how to build your team, whether it be your internal teams, people to help you to underwrite, to raising capital, to due diligence, to construction, to asset management, to balance sheet, to your external team, which could be your brokers, your property manager, your insurance people. So we talk to all those different facets and where you can best fit in the puzzle. Should we do small multifamily or large multifamily? Where to start? And honestly, how do we run these properties once we have them? How do we find the capital? How do we raise millions and millions of dollars from our network? How do we build brand authority? How do we create the marketing to go out there and be in front of the right people that want to find these deals? Why is multifamily an attractive space? What is it about the cash flow, the appreciation, the depreciation, the debt paid on, the tax advantages that make this one of the greatest investment spaces out there? So we're going to bring all that to you live June 2nd, 3rd, and 4th, called Multifamily Live. But today, we're going to dive in here. We're going to talk about internal rate of return and look to really just simplify it, right? So in short, internal rate of return, you'll see it a lot as IRR. It's the rate of return you're going to receive based on time value when that's factored in. For instance, the easiest thing to think about here is ultimately what's more important. If I gave you $1 and for you, you would return $1 to me plus another $1, so $2 in 1 year. Would that be more valuable to me, or would it be better if I gave you $1, invested $1 with you to get $1 in 1 year and another $1 the year after? Well, ultimately, it's the same effect, right? I'm going to get back $2. But what's factored in here is the time it takes for me to get those $2 back. In the first instance, I invested $1. And within a time frame of 1 year, I got back $2. And in the other instance, I invest $1 and I get back $2, but it takes me 2 years. So what is more important, of course, is the time value that it takes for me to get my money back. It's the example of, a bird in the hand is better than 2 in the bush. It's much better to have your money back earlier. So that's going to drive a much higher internal rate of return because the value of your money comes back quicker to you. So as you look at IRR, don't let this accomplish or something that makes this very complicated. Typically, when you do the cash on cash return in a deal, it means the cash that's left over after you've paid all your expenses, after you've paid your debt service, the cash that's returned to investors each year, not taking in the profit from the sale. The average cost of capital, and that cost cash on cash is basically an average across all the years. Maybe some years it's 5%, some years it's 10%, some years it's 20%. It values that across. Your average return annual average return includes the profit from the sale as well. And for that instance, that gives you a number that's, again, an average. The IRR takes into account how those monies are received. If you invested $50,000 today, how is the flow of income coming back to you? In year one, potentially you receive $10,000, year two, $20,000, year three, $5,000. And in year four, potentially you get $85,000, which includes the return, the rest of the return of your money. So that's going to be a lower IRR than if year one here, you will return that same amount of money, about $110,000, $120,000 in that first year. The reason for that is more beneficial to have the money back in your hand today. And you can think of a lot of reasons, right? Inflation or other notes, which makes a dollar today much more valuable to a dollar into the future. So here are some examples here. If you invest $100,000, 1 year later, the GP sells the property, you gain $20,000, meaning that $100,000 was returned to you. And in fact, you also got an additional $20,000. So total return to you is $120,000 based on your $100,000 investment. That would be an IRR of 20%, right? So that's going to include your capital back. And on top of that, you get the additional $20,000. However, if you invest that same $100,000 and there's no distributions for 4 years, so no money comes out at all. And again, after that 4 years, you are rewarded with $120,000 back. Same effect here. You've now received back your original investment, which is $100,000. And you've also received the additional $20,000 as profit here. Well, your IRR drops down to about 5% because it took 4 years for that investment to come full circle in terms of the income streams that come to you. So honestly, it's really looking at here the simplicity of to get your net present value to zero. What is the streams of income? And with those streams of income, what is the weighted average cost of capital to make the net present value back to zero? So if you put out $1,000 today and you get back $500, $700, $300, $400, $500, what is that rate of return to make the net present value zero? So some things to think about here as you look at your investments. What are some important metrics that are important to you? IRR is simply going to be the benefit of how does the money get returned to me, in what fashion? And the quicker money comes back, the higher the IRR will be driven. The longer that it takes for that money to come back, the lower the IRR will be. The cash on cash, of course, is going to be an average. The same with the average annual return. So that's just going to give you a full overlay of the entire deal. On average, what happens across the entire deal from year to year? Where we can use IRR because it can help us understand, well, if we hold this property for longer or we look to sell it shorter, potentially the IRR may be driven up dramatically by the shorter sale, and it may be more beneficial for the investors to be able to have that money back, and then that money can be rolled into the next investment and repeat. All right, so again, I'm Ursi Holdings. Want to go back here, share a little bit. We are now doing these awesome weekly webinars here. We have Multifamily Live coming up June 2nd, 3rd, and 4th. It's live here in Nashville. We're at the Opryland Hotel. If you have not been there, it's just a fantastic space. It's just something awesome for you to dive into, for something for you to join, something to come down and meet so many other like-minded people looking to go out there and continue to crush it in multifamily or just get themselves started. Our company, Ursi Holdings, you can come here, find a lot about us. Go and see some of the current offerings we have. You can go to our investor portfolio here. You can look at our portfolio of the current properties that we've now either are still operating, have sold, or current offerings that are coming up into the future here. Thanks so much for joining us. We'll see you next week. We have another great topic coming from you, and dive back in there. Make IRR simple. It's a complicated formula, and that's why we'll use the things like Excel and other points to be able to, of course, get to that number. But just understanding why and when to use it, that's the power you can take back for yourself to help you make the best investment decision going forward. All right, I'm Jason Ursi. I'm Ursi Holdings. Again, thank you so much. You want to learn more about us, go to ursiholdings.com, and we'll talk to you shortly.